So you're in your 20s and you hear the word investing, and maybe it feels a little overwhelming, complicated. Well, what if I told you that you already have the single most powerful tool for building wealth? In the next few minutes, we're going to lay out a super simple roadmap to get you started. Let's do it. Okay, let's start with a question that kind of flips the script. When you think about what it takes to build wealth, what's the first thing that pops into your head? For most of us, it's money, right? You need a big pile of cash to get started. But what if that's not actually true? The answer is time. Seriously, when you're in your 20s, time is the most valuable asset you have. It's way more powerful than starting with a ton of money, and it's more forgiving than trying to pick the absolute perfect stock. And we're about to see exactly why that is. And that leads us right into your financial superpower, compounding. Now, this isn't some complex Wall Street secret. It's a really simple idea that can totally transform your financial future, and it works its best magic when you give it a nice, long runway, like decades. Think of it like a tiny snowball at the top of a really, really long snowy hill. At first, as it starts rolling, it's small, but as it rolls, it picks up more snow, getting bigger and faster, which helps it pick up even more snow. That is exactly what compounding does for your money. Your earnings start making their own earnings, and over time, that growth just explodes. And this is where it gets real. Just look at this chart. You've got three people all investing the same amount of money, but starting at different ages. The person who starts at 20 ends up with a portfolio that's literally 4 times bigger than the person who waits until they're 35. That's a 300% difference. That's the power of giving your snowball more hill to roll down. Okay, so we get why we should start early, but what even is the stock market? Let's decode this thing. I promise, it's not nearly as scary as it sounds. At its heart, the stock market is just a giant marketplace, like an Amazon or an eBay. But instead of buying shoes or gadgets, people are buying and selling tiny little pieces of ownership in some of the world's biggest companies. And that's all stock is. I love this analogy because it makes it so clear. Imagine a big company is a giant pizza. Buying one of its stocks is like buying one slice. And guess what? That makes you a part owner of the whole pizza. If the company does well, if that pizza gets more popular or more valuable, your slice is worth more. It's really that simple. So how does this whole marketplace actually work? Well, you've got the exchanges, like the New York Stock Exchange or NASDAQ. That's the actual place where the buying and selling happens. Then prices are all about supply and demand. If a ton of people want to buy a stock and not many want to sell, the price goes up. And finally, you have indexes, like the S&P 500. Just think of that as a scoreboard for the whole market, tracking 500 of the top companies to give us a quick snapshot of how things are going. All right, now we know what the market is, so let's open up the toolbox and see what you can actually use to start investing. Think of these as the different tools you can pick from for the job. You've basically got two main paths. On one side, you can buy individual stocks. You're picking specific companies you really believe in. This has a higher potential reward for sure, but also a much higher risk. On the other side, you've got ETFs and index funds. Think of these as a pre-packaged basket that holds hundreds of stocks all at once. By buying just one share of that fund, you instantly own a tiny piece of all those companies. It automatically spreads out your risk, which makes it a way, way safer starting point for beginners. And as you can see, there are a few really common ways people get started. We talked about ETFs and individual stocks. But you also see retirement accounts here, like a 401k you might get from work or an IRA you can open on your own. Both come with amazing tax benefits. And for anyone who just wants to set it and forget it, there are robo-advisors, apps that just invest your money for you. Pretty cool. Okay, I have to stop here for a second because this is so, so important. If your job offers a 401k with an employer match, it is literally free money. I mean, they are giving you money just for saving your own. It is the absolute highest return on your investment you will ever find, guaranteed. So the rule is simple. Always, always contribute enough to get that full match. Don't leave free money on the table. All right, enough with the theory. Let's get practical. How do you actually do this? How do you make your very first investment? We've broken it down into 5 super simple, totally manageable steps. You can do this. First things first, build your base. That means having a budget and an emergency fund with 3 to 6 months of expenses. Seriously, don't skip this step. Second, pick an online broker. There are tons of great, easy-to-use apps out there. Third, fund the account. Just link your bank and transfer some money in. Fourth, pick an investment.
A broad index fund that tracks the S&P 500 is a fantastic, no-fuss place to start. And finally, number 5, you hit buy. Search the fund, click the button, confirm, and that's it. Boom! Congratulations, you are officially an investor.
Okay, so you're an investor now, but that's just the beginning. The market goes up and it goes down, and being successful long-term is all about having the right mindset and following a few simple rules for the road.
You've heard this a million times, but it's the golden rule of investing for a reason. Don't put all your eggs in one basket. It's the whole idea of diversification, and it's the single best way to protect yourself from things going wrong. So, here are the 4 big rules to live by. First, as we just said, diversify. Spread your money around. Second, think long-term. This is a marathon, not a sprint. Third, and this one is so hard but so important, keep your emotions in check. The market will have bad days, and you'll be tempted to panic and sell. Don't do it. And finally, protect yourself. Only invest money that you can afford to not touch for years. Your rent money? That belongs in your bank account, period.
And this slide just nails the difference. On one side, you have the risky sprinter, always chasing the hot new thing, trying to time the market and reacting to every single news headline. On the other side, you have the smart marathon runner. They invest consistently, they hold for the long term, and they just stick to their plan. And guess who almost always wins over decades? Yeah, the marathon runner.
So that's it. We've covered the why, the what, and the how. Your journey as an investor doesn't have to start with some giant, scary leap. It can start with a single, small step, taken today.
Let's just come back to this number one last time, because it really says everything. 300%. That is the kind of advantage you have in your hands right now, simply because you're young. That's the power of time, and it's an advantage you only get once. And please remember, the biggest thing stopping most people from investing isn't a lack of money or knowledge. It's just not starting. You do not need to be an expert. You just need to begin. Open the account. Make that first tiny investment. Trust me, your future self is going to be so incredibly grateful that you did. So I'll just leave you with this final thought. Imagine yourself 30 years from now. The small, consistent choices you make today will have snowballed into something you can hardly imagine. So what will you be glad you started?